welcome to this weekend edition of Taking Stock. This is a show where we highlight what took place in the week that went by, but more importantly, we put together some triggers for the week to come. I'm Sonia Shenoy. With me, as always, is Anuj Singhal. Hi, Anuj. It was a volatile week for the Lal Street. So for the first part of the week, we actually made an attempt to get to the all-time high, and then all of that was undone on Friday. So pretty much back to square one.
Back to square one, Sonia, indeed. And you know what? Interesting is that at some point this week we were in the green for the year. By the time the week ended, we were down for the year, about 0.5%. More importantly, this market is just not broadening out. The mid-cap index is now down 5% for the year. Nifty Junior is down 5% for the year. And this week, a lot of stocks actually broke down. M&M Financials for that matter, Ranbaxy on Friday.
Kotak Mahindra Bank also.
Kotak Mahindra Bank. Earnings reactions also were slightly on the muted side. If you leave out an L&T, I don't think a single stock really reacted on the positive side to earnings in a big way. So quite clearly, this was a disappointing week. But next week is interesting. It's expiry as well. So let's see how it goes. And then everyone will talk about the RBI monetary policy as well. So lots lined up. Let's see how things go out. And
what spooked the market at the end of the week was clearly the global cues and the weakness over there. Yeah. So let's see whether there's any incremental worries that trickle on into next week. But we have two guests to answer all those questions for us. First up, joining us on the show is Sandeep Shah, the Associate Director at Motilal Oswal Private Wealth Management. Sandeep, hi. Thanks for joining us on Taking Stock. It's good to see you in after a long time. It's been a sticky start to the year, not just for us, but for a major part of our global peers. How are you approaching, the next couple of weeks for the markets, and what have you made of the cues so far?
Well, there have been a couple of disappointments. One has been the fact that post the AAP government in Delhi cutting power prices, we've seen a lot of states already cut prices or threatening to do so. And to my mind, power remains one of the most important pieces or areas where reform is necessary in India. And in that sense, is like a showpiece, a sector in a sense for reform. So that's where clearly looks like things have taken a backseat. So that's one. Secondly, the monetary policy framework which has been given, I'm not sure if the RBI has totally accepted that, but that has been extremely hawkish because they're targeting about 400 bips cut in inflation by in a couple of years, which I think is a very drastic recommendation. And as you rightly mentioned, clearly there seems to be some a slowdown in China, and I think it's important to put this into context that if you look at last year, the best performing sectors were IT and pharma, which is a lot of it is actually partly driven by the recovery in the global economy, and to the extent that China represents to some extent growth in the global demand, the hopes of an export-led recovery in India as well do get diminished to some extent. So I think these are some of the factors which have affected the market right now in the very short term.
Sandeep, hi. So how would you construct a portfolio now? Because it's back to defensives now. For seen IT and pharma being the only sectors which are trying to eke out any kind of outperformance. Do you think it's back to that kind of trade, or is there a chance that after this weakness is over, maybe it will be back to cyclicals, metals, and a couple of capital goods?
Yeah, well, given the fact that there is a fair amount of uncertainty even now as far as who will win the next elections and whether there will be a significant mandate given to a strong government, and currently that's read as the NDA. Unless and until we find a plethora of opinion polls suggesting an overwhelming victory for the NDA, of course, almost all national opinion polls, as even exit polls, have been inaccurate, and I think the market is cognizant of that. In that environment, I think it really makes sense to stay invested with in stocks which have high quality, high growth potential, the standard requirements of high return on capital employed, free cash flow, strong management, And you're right, that's currently strongly represented by IT and pharma companies. Obviously, we are not going to see the kind of outperformance that we've seen last year. Last year, the IT sector was up 60%. You're unlikely to see anything even remotely close to that. But I think even if stocks, move in line in tandem with earnings growth, I think you could still see a reasonable return both from IT and pharma stocks. So from a risk perspective, given the fact that there is still unclarity and perhaps the voter himself today is undecided, I think it doesn't make sense to actually invest in the beaten down sectors or the cyclicals till such time that there is a clear sense as to who's going to form the next government and whether that government can actually deliver.
But won't it be too late by then, Sandeep? Because there's so many who believe that a pre-election rally has already started to play out. We are in any case at record levels, at least on the Sensex. Would you use any dips in any of the private sector banks to perhaps put in money? Because we saw, cracks in names like Kotak, etc. last week.
Well, private banks have been holding up for quite some time along with, IT and pharma, but we are finally for the first time beginning to see some signs of the slowdown in India's GDP growth impacting not just loan growth. It has been impacting NPAs incrementally, but we're really seeing that a strong impact really coming in terms of loan growth. We've had, for the last 2-3 years, at least 3 large private sector banks which have been growing at over 30%. And this quarter so far, we've just seen one of them grow at 30%. There clearly is a bit of a slowdown, but yes, I agree with you that, some of the quality large private banks, I think can be accumulated at lower levels, but without a sense that there could be an immediate rebound unless and until we see strong signs of the economy really recovering. Because what we're seeing right now in terms of the earnings rebound, for example, this quarter we think that Sensex earnings could be up about 13%, but a lot of that is coming from the export sensitive sectors. So till we actually see a signs of economic growth seriously bottoming out, you will not see any significant outperformance from there. But given the fact that these banks have very strong management, they're fairly robust business models, very strong brands, yes, it would make sense to buy them from a medium-term to long-term perspective.
Well, let's talk about a couple of other sectors then, and how would you approach them in terms of FMCG, because we had a couple of names come out with earnings disappointment, but there's some argument over whether Asian Paints was a disappointment or not, but without getting stock specific, how would you approach FMCG now?
Well, clearly there is a slowdown underway. Clearly we've seen volume growth come off for most companies, and where volume growth continues to be steady, we see profit growth has come off. However, we think that the Indian consumer story remains a long-term growth story, and once we find that there is a recovery in the economy, you will see these stocks again perform as well as earnings perform. So these aren't stocks you want to chase right now because there could be a little more pain ahead. If nothing else, at least there could be more stagnation even if stocks don't correct. But from a longer term perspective, I think that we do believe that there is merit in buying these stocks, as India's GDP growth increases, and as we move from 1.5 trillion to 3 trillion, you will see a lot consumption continuing to go up the J curve, and from that perspective FMCG stocks can be accumulated on bad news.
All right, Sandeep, thanks for joining us and giving us your view. We'll let you go and enjoy your Republic Day. I see you are extremely patriotic today, but thanks so much for joining us. You have a good weekend. Well, that's the word coming in from the fundamental expert, but when we come back from the break, we'll get a view from the technical expert.